analyzing the Magnificent Seven stocks from the best one to the worst one. That's what I'm going to talk about in today's video. I think it's a timely update as a lot of those companies have reported earnings, and it's a very interesting price action of the Magnificent Seven, down 7% year to date versus the S&P, which isn't even down 1%. Just 1 or 2 years ago, people were talking about big tech dominance and why big tech keeps on winning, but now a lot of people aren't too interested in big tech, and that makes me very interested, and it's a really good time to be analyzing them, buying them, talking about them. And I'm gonna try to keep the video short, so I really hope you enjoy it as always. Now, for me, the most undervalued one of the big seven is Amazon, and I just did a video on Amazon, so I'm gonna keep it short, but it's down 18% on the month. Amazon has something that most of the big seven and most of the big companies, they don't have, which is a physical moat. A lot of companies right now and software stocks, they're going down due to AI disruption. Some even big companies could realistically be disrupted by AI, but you cannot code distribution centers. You can't code workers. You can't code trucks and the distribution network that Amazon has. You can't code, having 28% market share in the logistics game in the United States, and you're about to overtake USPS. This is a physical moat. Physical moats are going to be very valuable over the next 5, 10, 15, 20 years because they add a lot of certainty and predictability to the company, but they also eliminate the disruption risk. Amazon has the lowest disruption risk out of all the big seven. And the best part about it is that, generally speaking, once a company has a physical presence, a physical moat, it used to trade at a lower valuation. Why? Because it takes a lot of labor and it's labor intensive, and it just leads to lower margins in general. But this is now changing in real time thanks to technology and thanks to robotics, which Amazon is a leader in robotics and automation technology. So this business that was priced at low margins, low multiples, over the long term is going to be priced at a much higher multiple as Amazon finds a lot of efficiencies within those warehouses due to the robotics and due to automation. But then you're also getting the advertising business, which requires little to no capex, guys. This is a $68 billion annual run rate business, amazing business. You're also getting AWS. You're getting so many different things, and you're only paying 12 times price to operating cash flow. This is one of the lowest. It's pretty much as close as what it was in 2022. It traded at 11, 10 times. Now you could buy it for 12 times operating cash flow. For a company that's growing operating cash flow 20%, expected to grow 27%, 27%, and 26%. And we didn't even talk about the Anthropic stake, which is worth 18% of Anthropic's market cap, is owned by Amazon, which is about $70 billion. So if you look at what you're getting for how much you're paying, Amazon is by far the most undervalued one of the big seven. And it is my second, you could say my third largest position actually in my portfolio. And I'm going to be buying the dips if it keeps going down. The second one is Meta. Meta is down 18% over the last 6 months. Meta is actually the only company out of the big seven that is actually finding efficiencies from their AI investments. They're finding results, they're saving money, and they're using the money they made from AI to reinvest it into AI. This is really not what a lot of those big sevens are doing, but Meta is pretty much self-funding their AI exploration. And this is an article from Morningstar. It says AI has helped supercharge Meta's core advertising business. Meta's annualized revenue run rate for its AI advertising tool is more than $60 billion. That means that Meta is already, via these tools, covering the incremental $60 billion in capex for the AI build-out. So pretty much, Meta has made $60 billion from AI. They're using the $60 billion to reinvest it in capex, and they're pretty much self-funding their capex explorations. No other companies doing this, and that's why Meta has been holding up a little bit better than Amazon and Microsoft and other companies year to date. It's eventually going to be breaking down. But amazing company, and they've been doing really, really well. Now, looking at Meta, it's trading at 20 times earnings. 20 times earnings, in my opinion, is ridiculous for a company that reaches almost 3.6 billion people every single day. So Meta can come up with threads, they can come up with the Meta smart glasses, any kind of product. They can advertise it for half the population for free. No other company can do this. Maybe Google can do this a little bit, but most companies, they really can't do it. And the power of this network is worse, much more than 21 times earnings. But the company is growing 23 and 26% in revenues, which is absolutely stunning. They've done it for a few quarters, and they're likely going to keep doing it for the next 1, 2, 3 years, in my opinion. And this is really amazing. So I believe Meta is the second most undervalued ones of the big seven, and I'm expecting it to do really well over the next few years. The third one, which I recently bought, is Microsoft. Microsoft is down 23% year to date. Looking at the valuation, it was trading at 36 times earnings a few years ago. Even recently, a few months ago, it was trading at 35 and 34 times earnings. It was the highest quality company ever. Well, now Microsoft is trading at 22 times forward earnings. 22 times is as low as their 2022 bottom. It was like 21, 22 times. We're getting very close, and close to where it bottomed back in December of 2018, when a lot of stocks crashed and Apple went to 13 times earnings. I was buying Apple back then, but I sold it like an idiot for like 17 times because it was expensive. But here Microsoft is looking really interesting at the lower end of the range. To me, it's a no-brainer, and it's gonna look like a no-brainer whenever the stock recovers. That's what normally happens. But looking a little bit deeper, the reason why Microsoft has sold off is because 45% of their backlog for Azure is due to OpenAI. And OpenAI is unprofitable. They're having some trouble raising money. So this is a big concern. But the remaining of the backlog, which is like 55%, is not tied to OpenAI. It's tied to Anthropic. It's tied to even non-AI workload. And this backlog is growing 28% year on year, and they're broadening the customer base. So I'm not really worried about the backlog because Microsoft is diversifying away, and OpenAI has a lot of money right now. They're going to be having an IPO this year or early next year. So I think if OpenAI goes to zero, it's not going to happen before 2 or 3 years. And by this time, they're going to be paying Microsoft, and Microsoft will be diversifying away from OpenAI. And they have a very smart CEO, so I'm not too worried about the OpenAI risk. I think it's overblown, and I think it's priced in the valuation at 22 times forward earnings for such an amazing company. They're growing earnings per share like 15% 2025, expected 22% 2026, 12% 2027, 18% 2028. So 17 to 18% earnings per share growth. You're paying 22 times for a company that used to trade at 30 and 34 and 35 times. I think it's undervalued, and I would see at least a 20% annual return, in my opinion, over the next few years with Microsoft, with the potential of a multiple expansion. Now, the first one is Google. Google, to me, I'm still not a big fan of the stock here. I've said the stock was expensive at 330, 340. I still believe Google is expensive. Google has been doing really well in terms of Gemini. They've been taking market share from OpenAI, and it's been going really well for them. But I've said it before, I'm going to say it again, that easy money has been made with Google. If you bought Google at, you could say 14, 15 times earnings, it went to 30 times. You made a lot of money. Congratulations. That was due to a multiple expansion. Google did grow in earnings per share, but they didn't grow earnings per share 100% or 150%. And they're not going to be growing earnings per share 100, 150%. So the multiple expansion story has played out, and it's mostly an earnings per share growth story. Now, Google is expected to grow earnings per share 6% next year, then 15%, 15%. So let's say they grow 15%. It trades at the multiple, the elevated multiple actually, of 26 times earnings. You're likely going to get a 15% annual return. You're not going to get life-changing returns buying Google at today's price, and you also have the potential of a multiple contraction back to 22, 23 times forward earnings, where it was always trading at near its historical average, and it has traded well below that on many different occasions. But again, you have the potential of a multiple reversion back to the average, which you don't have with Microsoft, you don't have with Meta, you don't have with Amazon. In fact, with Microsoft and many of those stocks, you have the potential of the opposite. You have the potential of Microsoft going back 27, 28, 29 times earnings once narrative changes. But you don't have this potential with Google. It's mostly a multiple expansion story. So for me, if I want to buy Google, I would not be comfortable paying more than 23 times forward earnings, which is the average. Now, taking the expected earnings per share for next year, I get 11.53, and I time it by 23 times forward earnings, I get $265 per share. So for me, my buy price or fair value on Google is maybe 250. So if it gets to 250, 260, then it starts to get interesting. Above $300, to me, Google is priced to perfection. It doesn't mean it can't do well from here. It doesn't mean SpaceX isn't a great stake and they're going to go public and all of that. But looking at the numbers, at the earnings report, and at the valuation in general, I'm not seeing a great risk reward relative to other stocks. And if I want to buy Google, it'd be under $250. I think that would be a really great entry point. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, it's give you 2 weeks of free access if you use my link in the description. The second one, or I should say the fifth one, is Nvidia. Nvidia has been holding up really well because it really is the only beneficiary from all the massive capex that big tech is spending. They're all spending on capex. Most of the capex is through chips and semiconductor stuff. And who's the biggest one? Nvidia. So that's why Nvidia has been holding up really well. AVGO has gone down, but it's still doing relatively well. And the semi stocks are likely going to do really well over the next few years. And I'm looking to be buying them, buying AMD and a few others again. But Nvidia has been holding up really well. Great company. It's actually not too expensive over here. It's trading at 26 times forward earnings. This is not bad at all for a company that's growing earnings per share 56%, expected to grow 64% next year and about 28% the year after. If those numbers materialize, and they could very well materialize due to the Taiwan semiconductor guidance for the next few years. Nvidia is cheap here. It's really undervalued in my opinion. But for me personally, I don't really like Nvidia because I believe ultimately those hyperscalers, they want to look for some kind of a discount on those chips. They want to look for the lower cost. Nvidia has the best performance, but I think they want to focus on cost, which is why I'm more bullish on AMD and AVGO than Nvidia because they have the lower cost option. And I think they're ultimately going to be pressured to lower cost due to the massive capex that they're spending. And Nvidia is not the solution for that. The solution for that is the custom AI chips made through AVGO and the lower priced inferencing chips, which are made by AMD, which is why I like those stocks a little bit better. Now, for me to buy Nvidia, I'm buying it at 20 times earnings. If it ever gets back to 20 times, as you can see here, it tends to bottom at 20 times. It bottomed in April. It bottomed back in 2023 around 20 times. 20 times in history. It tends to be like a great buy on Nvidia. If it ever gets there, you just close your eyes and buy the dip. That's how I think about it. Now, for Nvidia to get to 20 times earnings, I could make the calculation, and I can use 772. And we'll time it by 20 times earnings. I got $154 per share. Nvidia right now is trading at $182 per share. So if it gets close to 150, under 150, Nvidia would be a really good buying opportunity. And you'd be buying it near its bottom PE ratio of about 20 times earnings. Now, the other stock is Apple. Apple is finally joining the other stocks on the way down. It has been holding up relatively well over the last year. They've been picking up some momentum over their phone shipments. They're gaining market share again. They're up 8% in total shipments versus Huawei and other Chinese vendors. They're actually declining 27%. So that was really surprising to me. And Apple has been gaining share again. That's really good. That's really encouraging. But looking at the multiple, it's trading at 30 times earnings. 30 times earnings, to me, is ridiculous for a stock that's growing earnings per share 10% and 9% and 10%, and revenues is like 2 or 3%. Most of those growth is coming through buybacks. But the reason why the analysts, they love Apple so much and they hate Amazon so much is because Amazon is reinvesting in themselves. They reinvest in research and development. They invest in CapEx. They want to better themselves. They're not giving it back to shareholders. But analysts, they're short-term thinkers. That's why they love Apple, because Apple spends very little on CapEx. They're left with a massive free cash flow balance of $123 billion. Then they buy back about $120 120 billion worth of stock, or I should say 97 billion worth of stock, and they distribute 15 billion as a dividend. So they're spending sometimes more than 100% of their free cash flow, returning it all to shareholders. And this is something good for the analysts, it's good for short-term investors, it's good for the stock price. And that's why Apple has been holding up well on a relative basis. But as a long-term investor, the last thing you want is a company that pays a high dividend yield or that do a lot of buybacks. You should want a company that reinvests in itself and tends to grow their business over the long term, widens the moat. This is not what Apple is doing, but this is what Microsoft, Meta, and Amazon are doing, which is why I prefer those businesses much better than Apple over the long term. And again, I don't really have a price for Apple because I just never want to own the stock. Tesla, I don't like to comment too much on the stock, and people told me you should say the truth that Tesla is an overvalued piece of trash or whatever. Yes, it is overvalued. I've said it many times. It's trading near at 14 times sales. That's near its 2021 peak. To me, it looks like a bubble. It looks like it's really overvalued. But there's a lot of things that could happen with Tesla, and they're going to try to merge XAI and SpaceX together, and Tesla could maybe get a piece of that. I've seen it in the articles, and you have the Elon Musk hype, which you can't really price in if it's 5 times or 10 times. Then you have the robotics humanoid kind of call option. Then you have the autonomous taxis kind of call option. And you have so many call options with the stock, and you can't really price for them. So for me, it's more of a speculative investment. Like if I ever buy Tesla, it'd be like a 1% position, 2%. I'll never put serious money in a stock like Tesla. And I just wouldn't be able to sleep at night holding at such valuations, largely due to the CEO. And what if something happens to the CEO? Then what is Tesla worth? Is it 2 times sales, 5 times sales? A lot of it is due to the CEO. And I'm putting a lot of money based on one person. It's all a one-person show. If something happens to that person, what happens to my investment? So I'm not really a big fan of owning Tesla for this reason. It's not like a business that an idiot can run. If the CEO is gone, the business is done, in my personal opinion. You don't have the right people that could run it. And it's definitely not going to command 14 times sales or 200 PE for a company that's not as profitable, it's not growing as fast in profits and in revenues in general. And that's my opinion on the Big Seven. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.